All right, tensions over oil, and as a result of which the Asian markets are treading water. That's exactly what's taking place. It's a subdued start for Asia as tensions in West Asia flare up. The Nikkei, the Straits, as well as the Korean markets, all of them in the red. Mild weakening seen for the dollar yen from yesterday. However, keep an eye out on what takes place in the SGX Nifty, because remember, yesterday was a good day for the bulls. The Nifty notched up gains of around 140 points. We had a good 420 points gain coming in on the Nifty Bank as well. More importantly, after 12 sessions of weak market breadth, we saw the advances outdo the declines, and that was a positive. Let's see what happens in today's trading session, especially given the fact that we've seen a 5% rise in oil overnight.
All right, let's talk about the US markets. Wall Street ended higher, cheering the possibility of further rate cuts next month. The S&P 500 surged to end at record high, whereas the Dow Jones ended higher by 250 points. The 10-year Treasury yield fell below the 2% mark for the first time since November 2016. CNBC's Eric Shemi gets us a wrap of what all happened on Wall Street.
U.S. stocks finishing higher, the Dow jumping 249 points, the S&P adding 27 and making a new record close, and the Nasdaq higher by 64. Oil prices jumping more than 5% after President Trump tweeted that Iran made a very big mistake for fueling conflict between the U.S. and Iran by shooting down a U.S. military drone. The strained relationship between the nations sending crude prices higher and also sending energy shares higher, like ExxonMobil, Noble Energy, and Devon Energy as well. Slack shares surging 50% in its market debut today on the New York Stock Exchange. The stock under the ticker WORK, work, opening at $38.50. That's about 50% higher than the reference price of $26 set by the NYSE on Wednesday night. Slack is part of a slew of tech companies to go public this year, including Uber, Lyft, and Pinterest. And shares of cruise operator Carnival fell more than 10% after the company cut its full-year revenue forecast. The company attributing the cut to the Trump administration's new ban on travel to Cuba, among other factors. That's the action from the U.S. market. Back to you in Mumbai.
All right, on that note, let's hear out some expert voices on the possibility of Fed rate cuts going forward.
I think the Fed will cut rates in July. We'll probably do it again in September. And I think it's less because of any real concerns about the economy. I think it's part of very low inflation. That's one of the justifications. I think the Fed is also looking at it to help extend this very nice expansion that we've had. The Fed's Fed funds rate has been above that neutral rate. And every time that has happened in the past, there's been some economic difficulties, 2005 and 6, 2000, and the early 90s. So I think the Fed is looking at some of those things besides the slowdown, the clear slowdown in global growth.
I think the bond market is right, and our view still is that we have a mild U.S. recession in 2020, so we would endorse that kind of move down. The Fed has become more dovish. Investors are now embracing the concept of the liquidity argument. It's about interest rates. That's all that seems to matter. People forget that the reason that interest rates are being cut and the reason is the Fed has done this pivot is because global conditions are getting worse, and U.S. conditions, we believe, will get worse. That will impact earnings and ultimately margins as well.
And we're a little bit more cautious, looking at U.S. equities hitting all-time highs. We want to go into next week with the G20 summit being a little bit more cautious simply because there's still no resolution on trade. And so the market is behaving as though the Fed is going to be the savior here. But until we get more information about trade and the outcome on trade, that does have the impact to affect corporate earnings and to potentially see a pullback. So we're sitting tight until next week.
We've seen an overabundance of corporate caution here, despite the fact that we do know that the Fed is likely going to move potentially in July. We still think that we need to see some de-escalation in the trade rhetoric and some good old-fashioned earnings growth to actually be able to sustain a rally above 3,000. So we're feeling a little bit cautious here, moving more towards the credit complex than we are in equities.
If you look at financial conditions, they're highly accommodative. Interest rates have come down, mortgage rates have come down. I don't have an opinion here because I'm really trying to figure out what the cost and benefit analysis is here. There is a cost to cutting rates. You're hammering the banking system. You can go down the path of Japan and the European Central Bank. Look at what's happened to the stock indices for banks. they've been hurt. And that affects, in the end, small business operators that are not listed that can't access markets. So at the same time, those that can access markets are seeing low rates driven by the markets. And you have to just weigh the cost and the benefit of what you might do. And I'm just saying right now it's a little confusing. It's not as clear cut, I think, as the markets are discounting for July and for September.
All right, and across the Atlantic in Europe, it was a strong close for the markets as they welcomed Bank of England and Federal Reserve interest rate decisions. Bank of England, remember, has kept the interest rate unchanged, but they've reduced the growth forecast for the next quarter to 0. All three indices end in the green. The DAX actually hit a 9-month high earlier in the session. That was led higher by delivery company Delivery Hero, which was high by about 10% on a stronger guidance. So outperformance coming in from the German index. By and large, central banks across the world striking the dovish note. We spoke with Jean-Claude Trichet, who's the former president at the ECB, who said Europe's vulnerability to protectionism is twice as big in the US. Listen in.
For the European, the trade issue is even more important than for the US because we are more open than the US. The vulnerability of the euro area economy to protectionism is, I would say, twice as big as in the US in terms of volume of trade compared to GDP. And also when you see the global value chain, which is incorporated in our own exports and imports. So we are very vulnerable, and that is a point I wanted to mention because the trade quarrel are started and entertained by the United States, and it's a big problem for the global economy, but particularly for Europe.
All right, let's talk about the currency space then. The US dollar sank against major currencies, putting it on track for its biggest two-day drop in a year after the Federal Reserve signaled it was ready to cut interest rates as early as next month.
In the world of commodities, meanwhile, oil prices spike as tensions in West Asia continue to heat up after an Iranian missile shot down an unmanned US surveillance drone on Thursday. That followed attacks on tankers in the Gulf of Oman last week. Crude prices soared after US President Donald Trump said Iran made a very big mistake. In fact, Trump later added that the public will find out about whether the US plans to retaliate with a military strike, but he says he finds hard to believe it was intentional. Listen in.
And I think probably Iran made a mistake. I would imagine it was a general or somebody that made a mistake in shooting that drone down. And fortunately, that drone was unarmed. It was not, there was no man in it, and there was no, it was over international waters, clearly over international waters, but we didn't have a man or woman in the drone. I think that it could have been somebody who was loose and stupid that did it.
Jeffrey Curry, global head of commodities research at Goldman Sachs, says there is more upside to the crude prices and it is not just impacted because of geopolitics. Listen in.
The world is a very different place today in terms of thinking about geopolitical risk than it was 5-10 years ago. First, all the oil, or at least Iranian exports, are already off the market. If anything, if you had an outbreak of war, they could get out of the sanctions and start exporting, so it could be modestly bearish. The second thing is you got the responsiveness of shale. It's fast cycle production. Prices go too high and you don't get an outbreak or any kind of disruption, you got too much supply. And the other issue is, why did the Fed cut? The global economy is a lot more fragile in terms of thinking about a price spike today than at other points in time. So you put it together, our forecast is 65 on Brent. We're trading around 64.